No, we're millennials. I'm sorry to.
What's the cutoff? Like 84 then?
I don't know what the cutoff is, but I do know we're millennials.
See,
So.
now I gotta Google this. Millennials, years. Let's see. And my
Yep.
brother is too. It's 81 to 96.
All right, guys. So we've finally reached the point in this first season where we want to talk about you actually investing your money. But before you even do that, you should probably do a little bit of paper trading. Danny, you want to talk about the importance of paper trading for a second?
Yeah, I recommend it if anyone's starting out at first because you don't lose any money. So you can set it up with Thinkorswim. There are a lot of websites. Investopedia is the one that I used initially, and you allot yourself however much money you want. Ideally, pick a big round number so you can really try different strategies and theoretically buy stocks and see how things work out. When I first started, I was generous with my fake money, and I started out with $250,000 and then deployed it and got to see how that would work out.
If you start with 250,000 in fake money or 1,000 in fake money and you're able to multiply it, you can see that your fundamentals are working and all that sort of stuff.
Yeah, that you're actually right about it. So when I started, it was 2001, and we were just after like September 11th and all that. I figured we're going to go to war with somebody at some point, and I loaded up on all the defense names: Northrop Grumman, General Dynamics, Raytheon that makes the Patriot missile, things like that. And that theoretic portfolio in like 18 months went up. I think it was like 70% or something absurd. So I
Wow.
was really upset that I didn't start with real money.
Exactly. But then at the same time, you knew at that point you're ready to actually invest your money.
Yeah. So that you always want to start, whether it's real money or fake money, have a thesis in mind, some sort of idea of why you're buying this, whether it's because the shares are undervalued or the sector might do better or they're coming out with a new product, some reason to be buying it. And like that, you have some, actual fundamental backing, whether it's just because the valuation's right or whatever the case may be.
All right. So you did a little paper trading. You feel pretty confident in what you can do here. And you got $1,000 of initial money. What should you do with that $1,000, Danny?
To start out, I would say split it at least three ways, being that there are no commissions now for most brokerages, so there isn't that drag on of costs if you're buying shares in something. But you don't want to split it too much either, because then you're really not going to have a significant stake. To have one or two shares of a company is kind of pointless. To start out, in no particular order, I picked three that I would recommend to start out with and put in $300-400 into it. Would be Verizon. At least you're going to get back on the dividend alone. You'll get 4% in a year. So on $400 or so, it's not a huge amount of money, but it's way better than you'd get in a money market, or a savings account with any bank right now, where you're probably only getting about 1.5% anyways. The shares have recovered quite a bit, but long term, I think you're still good on that one. I do recommend Verizon, particularly because they are in telecommunications. People don't tend to suddenly suspend their cell phones because of a downturn in the economy. A small percentage may, because they lose their jobs, but connectivity is pretty high on most people's list of priorities behind shelter and food. So with that in mind, they should be a pretty steady performer over the next several years, whether the economy does well or not. So I really like Verizon because of that. Cheniere Energy I like for the same reasons. People will continue to need to heat their homes, and to a lesser extent, natural gas is used as a transport fuel as well. So they have a pretty solid supply curve and demand curve, I should say, where regardless of where the economy goes, they're going to have pretty steady output of liquefied natural gas heading overseas for heating in Europe and everywhere else at that point. They're an energy stock, but they are more aligned with natural gas rather than oil. So the stock will do well long term, and they are actually in the business of liquefied natural gas. That's why they picked this symbol. It really doesn't have anything to do with Cheniere Energy, the name per se. It's more so what they do. They're liquefying natural gas for export globally because the U.S. is such a large producer and has so much natural gas domestically here stored on the ground. So India is the only one that really has some sort of real economic cyclical risk to it. If we are in for a very prolonged recession, hotel occupancy rates may stay lower than they've been over the last decade. But either way, at the valuation that it's currently at, I wouldn't be shocked if someone comes in and buys them out long term, just because of the fact that it would cost more to put up 67 hotels right now than the $400 million that the company is currently worth. I will say I do own of all the stocks we've covered so far. I really haven't had stakes in them, but in this one in particular, I do own quite a bit of they are a hotel REIT. They own 67 Hyatts and Marriotts throughout the U.S. only. As you can see, the share price is quite depressed. But long term, I would expect it to end up probably in the $8 to $10 range over the next year or two. And the dividend should be pretty significant within a year or so. They've suspended the dividend meanwhile because of all the uncertainty for tourism and travel in general. But long term, I think these hotels will do well. And at the price it's currently at, these hotels are only valued at like it's right around like $6 million each, so probably below their replacement cost. So before you get into any investment, you need to have a pretty good idea of what your target is and what kind of return you're looking to get. Buying Verizon, it's not going to double. It's not even probably going to go up 30% in the next few years. You have to have realistic expectations. So bear that in mind when you're buying into these things, where if you plow $1,000 evenly into those three names, besides in having the big upside, the other two really aren't going to make you, a millionaire by any means. In could possibly double in the next year or two. But that means you will have made an extra, $300. So just got to have realistic expectations whenever you're investing.
So we're not making big time money with $1,000, but it is a way to just get into stocks initially and to just play around with it and understand what you're doing and understand you're not getting into this for any sort of short-term gain. Hopefully that helped you guys out, and stay tuned. Next week, we're going to talk about what you can do with $10,000. Until next time, just do us a favor, just subscribe and like, and hopefully we'll see you in our next video. Thanks again.